Good morning, folks. How are you? Happy Monday morning. Hope you had a pleasant weekend. Could you guys give me a heads up on X? Let me know you can hear me. Morning. How are you? So be able to hear me. I just heard my own audio check. Awesome. Thank you for that. Thank you so much. All right. So I just want to talk a little bit this morning. I'm not going to go all the way to the opening bell. I'll move over to X if there's anything that's noteworthy after I'm done with this presentation here. So if you take a look at your economic calendar, and you can use Econoday, you can use Forex Factory, um, whichever one you prefer, really. You'll notice there's an absence of any kind of significant news drivers today. But Tuesday we have CPI, Wednesday it's PPI and retail sales, and then Thursday's a heavy hitter. We have Philly Fed, manufacturing index, and employment claims. So Tuesday and Wednesday are going to be wild. That's the face rippers. the, the market literally just, well, it's impossible to trade them, okay, without it being a gambling. So it's Monday ahead of all that. So I don't have a whole lot of expectations in terms of big movement. They're going to reserve that for Tuesday, Wednesday, and Thursday. So how do you trade those environments? Or let me rephrase that because we don't give trade advice here. We don't give signals or anything like that. But how do you practice in price action? Well, you want to define price in predetermined PD arrays or points of interest, things that are salient because of liquidity and or imbalance or inefficiency. So when you incorporate time in association with one or the other, that's the only thing that can happen with price delivery outside of manual intervention, where there's a complete and utter disruption because of something that happens geopolitical or something unexpected. Okay. So years ago, we would see surprise rate announcements and whatnot, and that doesn't happen so much anymore. But the point is that type of thing can come in and unsettle the marketplace, and they'll use that immediate abrupt change in sentiment to run against the market's current sentiment. So if you've been watching the stream here, I had this the overnight Asian session buy side liquidity pool highlighted, and I'll cover why that level was important, but also what would be important for me going forward as we go into the 9:30 opening bell. So I'm going to talk to you about till 9 o'clock, and then I'm going to break, and I'm going to grab myself something to eat, and then I'll be watching the 9:30 opening bell to 10 o'clock opening range with you via Twitter or X. I'm not going to call it X, but you know what I'm talking about. So I have some old, stale PD arrays. Not that it's not good, but I'm showing you that it's old information. But because I use the frame of reference of a look back period of 20, 40, and 60 days, your highest probability precision, high frequency setups are going to form in the last 20 days. So if you're looking back over price action for the last 20 trading days, not calendar days, you're looking at the crispest, the most precise, the most salient, the most responsive, respected PD arrays that would be in my range of interest. Now, if we get to a point where there's a whole lot of action used on them, and what do I mean by that? If we have a range that's defined as a weekly opening gap, a new week opening gap, or a new day opening gap, or a regular trading hours, opening range gap, they're all different. Okay. And all of those inefficiencies, if they exist, they're going to be really important for me over the last 20 days. But when I first introduced the concept, using them on your chart, because everybody understands that there's a opening gap. That's not an invention of mine. The idea of grading it, using it more than just today, or if it fills in the gap. Okay, if it closes up the gap, usually everyone else in the industry has always said, okay, well that's one and done. It's over and trash. It's no longer important, and that's a mistake. And by teaching initially, by having them on for at least 5 days, it'll help you appreciate the fact that whether they fill in or stay open, they're important. They're not just discarded simply because they traded into them or overlapped them and went the other direction. They're still useful information because they're points of reference that the algorithm will. Oops, I'm sorry, that doesn't exist, right? It's a point of reference for price action traders to use their buying and selling pressure. Sorry, I got to just stick that in there whenever I can, right? So when we're looking at days like today, where the economic calendar is kind of anemic, it doesn't really have any kind of economic drivers that would be medium impact or high impacts. It's really forcing you to look at just pure price action. And that in and of itself is not bad, but how do you engage that? Like, what do you do? What do you look for? Well, I purposely kept these old PD arrays here because they're from last week. Okay, and you can see the reference points here. This is the first presented fair value gap from January 2nd. Okay, so that's 2 Fridays ago. So it's not last Friday, but the Friday prior to it. Okay, and I have it graded. These are on the eighths. Okay, and you can see the sensitivity around all the eighths and the regular quadrants that are based on quarters, not quarterly theory. Okay, we're just measuring a range and we're dividing it into mid range, upper quadrant, lower quadrant, and high and the low of the range. So it kind of like removes the ambiguity. It gives you a very specific level, and you don't have to worry about guessing what low to use to draw a diagonal and supposed support and resistance on trend line stuff. Okay. Love you, Tori. No, no diss. Okay. But I don't use that information except for targeting. Targeting. If I can see a diagonal trend line, whether it be viewed as supposed resistance or support, when it's clean like that, when it's obvious, and it's diametrically opposed to what I think the market's most likely going to do next, I'll target those types of things. Otherwise, I'm looking for clean highs and lows, which let's go over now why this was running on the live stream before I started talking. Let me get this little bit of business off here first. All right, so make this a little bit larger in case you guys are like me, visually challenged in your older age. So Asian session buy side liquidity. Okay, and why is it being called that? And why is it important? If you look at all these highs in here, look at the time that high formed. It's 10 o'clock in the evening last night during Sunday's Asian session. Now, that's not the Asian session kill zone. Okay, Asian session kill zone is 7 a.m. to 9 p.m. Eastern time. That's like the sweet spot for trading. It's like a nice little 2 hour window where you can go in here and scalp and get something. There's usually always a first presented fair value gap in that you can use. There's always some old high or old low it can run for. And I'll look at that in a second. But for now, just let me cover the point of which why I'm calling it the Asian session buy side liquidity. Asian session ends and closes around 5 a.m. Eastern time. Okay, so that's about right there. Okay, so if this is our delineation for Asian session close, and this is for Forex, for equities, index futures type thing, that's your delineation right there. So what you want to do is visually represent a starting point of that and then go back through Asia session. So 7 o'clock in the PM, 7 p.m. Eastern time. Look for the obvious smooth highs or lows. This was highlighted before the stream began with me talking, so you watch it, you can see it, and that was the draw on liquidity. It's smooth, okay? And this high here, while it did take this short-term high here and rejected that, they left that. That's engineered liquidity. Now, engineered liquidity is where the market will run to an obvious level. Okay. And now, when I say obvious, that is synonymous with retail. Okay. So don't get your panties in a bunch, little boys. Okay. Whenever a level on the chart looks like a perfect classic scenario of what every textbook shows as a resistance or support level, they always show it like this: high, 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 high. They're going to say that's a strong resistance level. Now, while I'll admit at that moment when it starts to drop down, that would be considered a present nice resistance level where price was unable to overcome that. I'm not looking at price when it's creating these types of things here and trying to trade that, because you don't know if they're going to run through that as a new trader or if they're going to continue dropping lower. You don't know that. So that's why I don't teach that way. What I do is I teach you to look for it in the past, because that's the trap. Whenever you're looking for smooth highs like this and it's framed on the basis of time, what does that mean? Well, the first primary function, what we're doing is we're looking for times in the chart where smooth highs and smooth lows or single highs or single lows exist. And I'll tell you what that is by contrast. But for now, just look at this and know that this is too smooth, and smooth areas in price action tend to become or made jagged. And you can see the price was meandering around off of some random box here. I probably just scribbled that on there from just, guesswork. And it rallied all the way up and traded into that smooth area. Look at the reaction it's been since then. I hate when it does. If I go up there too high and it creates that little bump like that. It's a good thing I don't have like a competitor using market profile, right? Because that would be really embarrassing. It would never happen. It's just- the guys, I listen real quick. Let me just toss it in here. Um, if I'm going to talk about any one person, I'm going to call them out by their name. Okay, so when you see these boys out there saying that I'm dissing them, this and that, if I say your name, then I am dissing you. But if I'm dissing what you use, it's a broad paintbrush thing. I'm including all of you. So smooth highs, smooth highs and smooth lows during sessions. So what does that mean? Asia, the entire Asian session, go through the whole gambit of the time. So that would look like this. All right. So the entirety of that range during Asia or the Asian market. And this helps me because in the book, it makes it a whole lot more dynamic by seeing this. So that way I can refer to on this day, I talked about how we frame very specific sessions. Sessions are not, okay? I see these people doing it all the time. Even brokerage firms are putting it in their information on their website too. ICT kill zones, okay? This is not the kill zone. This is the entirety of the session. So there's a difference. When you look at the entire range that's available, you would include all of this. So that's the Asian session high, and that's the Asian session low. See the difference between that and this? Take away that, right? Because that's not, we don't want that. But this is the entirety of the Asian session kill zone. See the difference between that and this vertical line and that vertical line? When you're looking for smooth highs and smooth lows, do not, listen to me, do not limit your perspective to only that of during the kill zones. You're going to find really good setups for that to, act as a draw on liquidity. But what happens if you already went outside that range, as we seen here? If you're only using my kill zone to look for the liquidity runs on relative equal highs or relative equal lows, this has already been used and it's useless to you, right? Because we've already went outside of that. And this is where a lot of questions come to me or confusions or they call it doubts. I have a doubt, sir. They'll put that in the comment section. And what I'm basically saying to you is there's nothing inherently wrong with limiting your search for relative equal highs or lows in that kill zone or any kill zone, like the London kill zone. That would be 2 o'clock in the morning to 4 a.m. That's your sweet spot, but it goes all the way to 5 a.m. Why? Because it's an overlap with Asia's close. Ooh. So you want to have that 3 hour window between 2 a.m. Eastern time to 5 a.m. Whether you're trading Forex, whether you're trading index futures, it's the same. It's the same. So when we're looking at the entirety of the Asian session, session is not kill zone. Okay. If it was just that easy, I never would have said kill zone. Kill zone is a very specific time during the overall broad brush concept of where are we at in the world globally trading right now. Well, at 7 o'clock in the evening Eastern time, Asia's coming on board, and that session usually winds down and closes up shop at 5 a.m. Eastern time. But during that time, you have the European session that's trading, and it usually closes around 10 o'clock, 11 o'clock in the morning Eastern time. So if you're going to be trading PM session, afternoon equities, NQ, ES, the Dirty 30, don't don't go hoeing. don't use Dow. Okay, because it's unruly. So did he just say hoeing? I'm into farming now. Okay, I'm into farming. So if you're looking for ranges to determine very obvious clean highs and clean lows, okay, if you look at it from a broad brush perspective like that, don't just limit it to the kill zones. Look at the entirety of the range, and you're going to see where's the obvious smooth level. Well, looking back, now that we've differentiated the kill zone here, I'm going to remove that because there's already a whole lot of things on the chart. But can you see how that's obvious? How retail traders would say, look at this. If I was writing a book on support and resistance only, and I wanted to use a classic example of it, this would find its way in that chapter or segment of the book because it's showing clear, obvious hindsight resistance. And that's where the advantage is because retail traders are taught to think that these things repeat. And I guess in a way, sometimes it does. Okay. But I have found in the last 34 years that when it's so obvious and the things that I like to look for are diametrically opposed. So in other words, if I can see a retail concept or some kind of logic that a new startup trader that bought a book would see in price action, and I'm seeing clearly that they're going to run those lows or highs out for the purpose of liquidity, then it's pretty much a 90% likelihood that I'm going to be correct in my expectation, but that last 10% can still get me, which is why we use stop losses. Okay, so real smooth highs versus where's the smooth lows at? This was the low during that Asian session, not kill zone. Okay, so we have this low here, which was going to be what? Think now, kill zone. This is the London open kill zone session low. So that would look like this. Find 2 a.m. Eastern time. Always set your time on your platform to New York local time. I don't care what anybody else tells you. That's what everybody's really watching in the financial industry. So we go to 5 a.m. right there. Okay. So that right there is your London open kill zone, not session. That London session goes till 10 o'clock to 11 o'clock in the morning. Okay. So basically, London close. If you look at all of my stuff on Forex trading, that is your window. That's a little sweet spot. We taught it as initially if you're trading London, the extreme of the range is usually defined by 10 o'clock to 11 o'clock in the morning. So that's profit taking if you're a London session trader or European session trader and you've been trading all night through Globex hours into regular New York session hours. There's usually a strong reason or suggestion to take profits at least around that time. Doesn't mean it can high or create the higher low of the day, but usually there's some kind of a tradable higher low, and it's beneficial for profit taking. So inside this blue box here, that is the ICT London Open kill zone, not the session. So when I go through the process, like we just came from a weekend, no trading until Sunday open at 6 p.m. What am I doing? When I first sit down, I'm not drawing out boxes like this and putting vertical lines on. Okay. My chart is completely naked. There's nothing there, which helps me also find the levels that are so perfectly clear. When you have all the lipstick on stuff like this, and I'm keeping these on here because I want to talk about a couple things before we close the session, and then we can go, pay attention on live price action on X. By having your chart naked, you want to have at least one of your workspaces where you keep a blank chart and don't have any annotations on it at all. Because if you put something on the chart, whether it's something that I use and teach or someone else is using, and you're hoping that this is going to give you some setup, what you've done is you've blocked out every potential opportunity. And this is really specifically talking to the newer traders or newer students or someone that isn't well versed in trading or reading price action. If you put an annotation on your chart, a level, okay, you've already committed all of your hopes and dreams and consideration around the idea of I'm not going to do anything until it gets to this level and it does something for me, and then I'm going to react. Okay, right away, you have completely closed your eyes to every potential opportunity that may present itself. And then you may be surprised because your experience level is too small. And I don't mean that to be derogatory, but you don't have enough experience to see when you're wrong because you're subscribing to an idea because you want to see yourself stick to a model. In the beginning, it's going to feel like you're floundering. It's going to feel like you're guessing and nothing seems right. And that's all normal. That's perfectly normal no matter what you're using. It's not limited to just me and market activity through the lens that I've presented to you. It's in every discipline of trading. No matter where you start, you're going to flounder in the beginning. You're not going to trust what you're doing. You're not going to know what you're doing. And that's what you have to do it for without expectation in the beginning. So you get a baseline. And every day you learn a little bit more and learn a little bit more. But where do you start from the beginning? Like, where's the beginning basis point? You have to look at time first. Where are you highlighting the bookmarks or you know, it's escaping me, the the framework at which you see that would have been a part where I would have hit Control M and then went in and edited it out and then said what I'm about to say here, where you frame the reference of time. And then inside that window frame, which we have here delineated for Asia, vertical line here and here. And then for London, this is your beginning point for the close of Asia and lunch for London. And we'll do 11 a.m. There you go. So beginning 2 a.m. And this is what you would be using reference for the PM session. Every single day, if I'm looking at PM session trading, if I want to consider PM session trading, this is the first frame of reference I'm looking at because I want a broad brush perspective. My chart would kind of be focused like that. That would be the reference in time where the highs and the lows, or wherever relatively smooth highs or relative equal lows would be. Inside of the range here, let's just assume for a moment that it's 9:30 p.m. Eastern time, which it's clearly not. It's 8:25 a.m. Eastern time, Monday morning, January 12th, 2026. If it were 1:30 p.m. today, this is the range in which I would look back through it and say, okay, where did they leave smooth highs and smooth lows? I'm not just simply looking at the highest high. I'm assuming, for the sake of example, let's assume that this was the highest it goes between, you know, 2 o'clock in the morning to 11 o'clock in the morning today. We still have some time to make that higher high here if it wants to. I'm just saying, by example, let's assume for a moment that this is the highest high it forms and this is the lowest low it forms. What I would look for is inside that range relative to that time. The time aspect has been utilized already because this high is higher than the highest high prior to it forming is here. So between this vertical line at 2 a.m. and this vertical line at 11 a.m., I'm looking for the highest high and the lowest low, and inside that range, because the time aspect is now complete. Now I'm looking for the price aspect. So it's first time, then it's price. So now what am I looking for? I'm looking for smooth lows because everything it's been pushed up to the high end. So we're in a premium market. So the first thing I want to do is say, okay, if it's going to go higher, now listen, folks, this, whether you like me or not, I don't care. Okay. Whether you like my concepts or believe in them, I don't care. This is going to help you in your own discipline. If you're someone else that's trading something else, if if you start a session and it's been moving one-sided, whether this market continues going higher or if it reverses and goes lower, it's still optimal to look for something that creates a relative equal low in all that price action. Because for the sake of argument, let's assume that the market's going to continue going higher. It's more likely for the market to drop down and disrupt the existing market run, knock out weak bulls. And how would they do that? They would target a low, relative equal lows. Then once it goes down there, it could resume going higher. Or you could just use that as the basis for that's what you want to be short on. And that you don't care if it continues going lower and you don't care if it reverses. That's the mindset I cultivate with new students. You're not trying to ride the entirety of the move. You're not trying to be right. You're looking for the easiest low hanging fruit objective. What is it likely to do next? You're not reacting to anything, you're predicting. That's what you're doing when you win. When you win a winning trade and you profit, what's the first thing came to your mind? You did something right. That's what you're saying. And when you take it to social media, what are you hoping that people say? Wow, that was awesome. You're the GOAT. You did that right. You see what I'm saying? So when you hear people, and a lot of these are mentors, quote unquote, they'll say, I am me. I'm trying to teach you to be right. No, that's a default of you doing the right thing, following a process that has a baseline that's statistically probable to continue in the future. Nothing is perfect. This is a statistical probability in your favor if you do these types of things, looking back through time, looking for smooth highs and smooth lows, and then limiting your focus to just simply looking for a setup that would yield a run into that. Now let's go back. I'm going to take these lines off because I've said enough about the time part of it. And this is the London open kill zone. So we have the high here and the low here. After 5 a.m. and we entered 7 a.m. And this is when you want to start expecting pre-market session trading. You can do all of your setups between 7 o'clock in the morning and 9 o'clock in the morning and never, ever, ever, ever engage the 9:30 opening or opening range. People are afraid to trade it because they don't know what they're doing. And that's what I'm teaching you today. I'm teaching you how to work within it, look for ranges to run for liquidity, because that's what this is doing between 7 o'clock in the morning and 9 o'clock in the morning every single trading day. Every single trading day. I don't care if it's a day right after a holiday. I don't care if it's a partial day where it's a holiday session where we close early in the afternoon. It's going to do this every single day, flawlessly, without fail. It's going to do it. You can set your watch to it. It's going to do it every single day. You don't need anything except for understanding what I'm about to say here. And you can encapsulate everything you would ever hope for if you have the time to be in front of the charts and look for it. Blue box is the London session opening kill zone. It's very specific because it's 2 a.m. start time and 5 a.m. close. 4 a.m. is the sweet spot. Okay, that's where your purest little runs that start or begin for the setup inside of the London. So if you're a London trader, if you're up at that time, okay, it doesn't mean you have to be living there geocentric, but it means that if you're focusing on that time of day, you look at 2 o'clock to 4 o'clock in the morning. And after 4 o'clock in the morning, unless it creates some kind of parabolic run to a higher time frame PD array, as you see it does down here, that green box is that daily suspension block high. And I'll draw out to a daily chart and show you where this all fits and all that. But you can see it drops pretty aggressively down into that, and it does form the low at 343, which is probably convenient because it fits inside the time window I'm telling you that these things form. But that low reacts off of some random goofball of a range that I put on the chart, 2 weeks ago and showed you, look at this, pay attention to this. And it's an old level. It's a stale level. And it's not a classic support and resistance level, boys. It's the top of a volume imbalance that's part of a buy side imbalance, sell side efficiency, which is not a liquidity void. Okay. So that reaction there, if it's running here and we close up shop kill zone wise, there's a gap of dead time. What does that mean? We're not doing anything from this point here to that. All of this information here, while somewhat useful, I'm not trying to engage in that. Now, when I was working with Forex, I would sometimes enter in because I would, if I had a really strong opinion, if I had real strong convictions about what I believed the market was going to be doing, then sometimes I would enter into that. And then, no doubt, some people would say, you're trading outside the kill zone, which I felt was fun. It was entertaining for me to do that. But as the creator of this stuff, I have the privilege to be able to do that kind of thing. So if you're listening to me to learn, avoid this area because it will keep you out of troubled waters. Okay, it won't bog you down in the molasses. Okay, you won't be trying to run in a swamp. Wait until 7 o'clock in the morning. Then the price action cleans up. It gets real nice. So, what would that look like? At 7 o'clock in the morning, here's first presented fair value gap. And we already had on the chart at the start of the stream before I even talked. We were looking at that clean level in the chart. So first presented fair value gap in pre-market session, it forms, trades down into it here, and runs to the clean levels here. So bread and butter setup in pre-market session time, discount array. Why is it a discount? Because where it's at in respect to the level that's relative equal highs, that run, that's a small little range, but it's a bread and butter type setup. And these things form every day. Do not take my word for it. Don't say, well, ICT said, no, no, no. Go back to your price action and look for it. Define the ranges as I just showed you here today, session to kill zone, and differentiate the two, know what they are. And by me talking like this over the live chart and showing you the examples of the contrast between the two, when I refer to them in print, you'll know what I'm talking about now. And it won't be a challenge for you to understand what the difference is because books are good in some respects, but there's a huge chasm between seeing it explained over the actual chart, especially like we're doing today. It's more dynamic, it's more impactful. You can see it, you can contrast it versus just a static chart saying, here's a box here, here's a vertical line here. And it's not the same because you're seeing the effects of running to price as it did here today. Right. So some of you are probably thinking, well, why wouldn't this little gap here? He's reading my mind. Why are you not looking at that little gap right there? Because that's not displacement. Watch. This little thing here, cute as it is, that is not important to me. That was, I would look at that as a common gap. This is not common. What makes it not common? See, common gaps when we were trading only in open outcry times with commodities. When I say we, I'm talking about my community that was with me back then. We would have common gaps exist all the time. So the daily chart would have all these open gaps that never got traded back to it would just continue moving in different places all the time. And these common gaps would just exist for a long time. This is an example of that. So a common gap is not an interesting gap to me. An interesting gap is one that has displacement like this. And what is displacement? It's a run through a high or low at a very specific time. What's the time? 7 o'clock in the morning. So now business should start picking up. Okay. And we know that there's a clear level of liquidity up here from overnight Asia session. So all of this here is a draw for price. As soon as 7 o'clock hits, I'm thinking I want to see something that's going to give me a run up into that level. Watch the very beginning of the stream. If you just joined late or you started listening to me at 8 o'clock, because I tweeted about it and said it's going to be live commentary at 8 o'clock, look what the chart was showing. It was sitting right there watching, price march up into it. And look how they reacted after being there for a little bit of time. This displacement towards the obvious retail concept. Okay. So if it's a relative equal high, as it is in this case here, this is the Asian session, high side liquidity. It's the smooth highs inside of all of the price action from 7 p.m. Eastern time to 5 a.m. Eastern time. So that entire window, we're looking for where is it obvious that it's left smooth highs or smooth lows? In this case, it's smooth highs. Why? Because overnight we only saw market go down. So whatever discipline you have, whether you're using market profile, whether you're using footprint, Elliott wave, if you're looking for pitchforks, if you're looking for moving average crossovers and then trading in that direction, whatever it is, okay? If you look for what price has done overnight and then look for the smooth highs or lows in that range, you're going to have pre-session or the first hour of trading's point of interest for index futures trading. And I just laid something in your hands that in without a doubt, there's going to be dozens of guys coming there. Dude, we all know this. Okay, show me your last 20 trading days where you use the information. Okay, when you see these people say it's always been there, ask them to show you the receipts where they used the logic and they made money with it, whether it's demo, okay, or real money. It's cancel culture time on goobers. Okay, we are not tolerating the opinions of others that have no evidence, no receipts. Because if stuff always existed, there's people using it with that logic in its own terms, and it's not rebranded. It's not used anywhere else. I'm giving you a whole different perspective. I've already disrupted the entire industry, and we're going to do it even worse this year. I'm going to rattle everybody. But you have to have a framework. You have to know why price should be considering your level of interest. Why is the fair value gap of any importance? Displacement is where we take out a short-term high. Boom. If we take out a low, here, that low. This is a noteworthy Sell side imbalance, buy side inefficiency. But let's assume for a moment, let's say you're bullish and you think that NQ could continuously go higher, but you have this. What do you do with that information? Do you try to short it there? No. You look for it to act as what? Inversion fair value gap. So then you would frame it and put the levels on it from the high, upper quadrant, midpoint, lower quadrant, and the low, and then you would study, and does price give you evidence that it's using it? Is it supporting that idea? If it's in a consolidation like this, it's less likely to give it to you because we're in a holding pattern right now. Because why? Why is it just sitting right here like this? Because the session, 7 o'clock to 9 o'clock in the morning, has already done its initial job, which is run to overnight highs that were clear, they were obvious. Retail seen it as resistance. They trust it, and it's going to run for the liquidity that's left up there. And that's where you get that run here. So it's not that it's an engulfing candle, okay? Because this candlestick here, one right before it, is has no bearing on what I'm looking at. I'm looking at this structure there. Low, high. This short-term high here was pierced with that high. And then this low and this low, relative equal, had it pierced there. This high, that low, and we're at 7 o'clock. What do we do next? Well, am I interested in seeing this low get taken out? No, because the smooth high is up here at Asian session buy side liquidity. That was what we showed on the start of the stream before commentary began. That's these highs here. And this one here is the trap. This is what throws off people. They're like, look at that, man. It couldn't even get up there. So this is strong resistance. I love that because what is this really the way I teach? They're relative equal highs. And it's high probability because the one to the right is lower than that one. That's the trap. That's the retail trap. That is the thing that you're looking for. Okay. You want to see that type of thing set up leading into 7 a.m. because then you'll have always something to do, whether you're practicing reading the tape or you're not really doing even a demo account entry or nothing like that. You're just watching and observing. And by having the stream started and it had like 12, 15, 12 handles before it ran up and took out these levels, the confidence that it yields to you by doing it, it helps with you knowing what you're looking for. And then it communicates to your subconscious that doing these subtle things doesn't require a whole lot of acrobatics. It doesn't require a whole lot of thought process. They're very simple things. This is very simple logic. You are looking for a framework of time and you're looking for where is it smooth? Where is it like obvious that it is respecting some specific price level? And wherever your eye jumps to where it's smooth, that's many times what you'll see the pre-market session, 7 o'clock to 9 o'clock in the morning, run to. Now, let's play devil's advocate for a moment. And let's assume that all this smooth price action up here, say that didn't get ran to, and it came down and it traded down into this first presented fair value gap from January 2nd. I would expect 9:30. I'm not saying this right now, so please don't take this out as a sound bite and say, see, he said, I'm saying by contrast, if this hadn't ran up there as it has already done, then any drop down would be viewed as a Judas swing during the 9:30 opening to 10 o'clock opening range, that 30-minute window. And then I would look for displacement to the upside. And if it was done on the basis of the first presented fair value gap, then I would use that there and then run up to that. And that's how I would use that during the first hour of trading. See the difference? Okay, so having scenarios, and I'm talking in hypothetical because what I'm describing has already happened here. So I wouldn't expect that type of thing because it, already ran for that liquidity. So what you're looking for is now inside of the 2 a.m. to 7 a.m. That is your pre-market session, but including overnight London session. So you look back through that range of time between that and that vertical line. Where in that range between these two vertical lines, where is there anything that's smooth? We've already taken out the high overnight here. We've already cleaned up and purged the Asian session highs. Does that mean it's going to drop and go lower? It could, but I'm trying to kind of like cultivate that idea that who's made money right now? London low, bulls. So between that low and what we have seen here as a high, go back through with your eye and look for relative equal lows. I like this. It's a nice block of price action there. And then I like this area here. And it's also the consequent encroachment of first position fair value gap of January 2nd. And the further we get down, because I'm admittedly, I'm still bullish on the daily chart. We can see objectives to reach for. Now, just because we have a level that we anticipate that may act as a draw on liquidity because it's a relative equal high or relative equal low, don't marry the idea. If you're brand new and you're learning how to do this, be aware that that might not be accurate for the session you're watching. It may use it later on. For instance, like London here, you may have looked at this area here and said, look at this is first presented fair value gap. It's 2 a.m. Let's trade it and then reach for these smooth highs. And it just falls short. The reason why that I teach partials because this type of thing here can happen where there's a high, it runs above it, but your objective doesn't get met until a later time. And if you're buying that fair value gap there, you can't weather that type of retracement, which is why we use stop losses, which is why I teach you to tape read before you even demo trade. Okay. These things have to be learned in a graduated fashion. It can't be done overnight. There's no fast track to being able to do this. There's no fast track to making money in anything. There is no fast track. And anybody that sells you that illusion, that dream, okay, they're rooking your impatience and your greed. And I'm not getting anything from you. I'm not asking you for anything. You don't have to watch my stream. You don't have to watch my videos. Just look at my Twitter. I say these things all the time, and it's for free. I don't monetize anything over there. I don't need anything from you. Okay. Don't come back to my channel. It's simple. I don't live off of that. So by having some rule based ideas, it helps provide you a structure mentally and psychologically that I'm only looking for a very specific thing in the beginning. And I'm going to measure the continuity and consistency. Does these things tend to repeat? But if you don't know what you're framing in terms of time, you won't understand where the liquidity is presently. You don't need Bookmap. You don't need all these bubbles all over your chart, which I don't understand that. Okay, to me, that that gives me anxiety. Okay, like these things that they have all these little bubbles all over. Okay, there's no advantage in that. That's something you're worried about the size of a bubble or all these types of visual representations when the open, high, low, and close is everything that the market's referring to. The market's not concerned about a bubble or how big that bubble is. Now I'm gonna kill Bookmap today. Okay. No offense, guys. Okay. But I'm just telling you before I say it, if it existed when I first started in 1992, I would have used it. I would have used it and I would have championed it. I would have said, this is what I'm using to help me understand liquidity. But if you're using it right now or you've considered using it, I want to kind of show you how you can see better visually with what I'm showing you here today without no requirement of additional apps that you have to pay for. You don't need to do those things. Okay. By framing the references in time, the kill zones and the session highs and session lows, and relative equal highs and relative equal lows, you will know where the bigger bubbles are going to be at. You don't need those types of things. And what is an example of that? Well, we have smooth highs over here, that high that failed to breach it. So there's going to be a lot of liquidity sitting there because new positions were entered there and existing stops here moved down to that high on shorts. So that logic tells me that this is a larger pool of liquidity. It's much more impactful and it's going to be a stronger draw. And it just so happens to be just shy of that level there. So if it's going to take out that high, it's going to definitely come back up here and sweep that out. And it's a relative equal high because of the definition I give it, which is it gives you a run to a level, it falls short of it, and then it gives you this little red herring run. And I love that. I love that because they're so easy to see, very simple little runs like this bread and butter setup in here. This is not the first one at the fair value gap. That is. So when you're watching the 9:30 to 10 o'clock in the morning, I'm looking for the obvious displacement fair value gap. Like if it, another rule of, general rule of thumb, if it's less than 10 handles in NQ, chances are you already 80% likely that that's not the first presented fair value gap. And I'll say it again because everybody went right over your head. If it's less than 10 handles, chances are I'm not using that as first presented fair value gap. I'm waiting for another fair value gap to form. That's why sometimes you've seen in my examples, why did you use that one there and not that? Now you know. See, it's dripped out because everybody's writing books on Amazon and using AI for my videos, and they're putting my stuff out there like that. Well, I never thought about that. Now here's dozens more coming. Okay, that's fine. You keep pushing my name out there because when my books drop, more people will know about it. But the point is you don't need to buy my books because I'm doing this for free here. But if you want the tome or tomes in text, obviously you'll have it. But knowing what you're looking for, where to frame it, on what basis, first on time, it's crucial. It's important to know what you're looking for and where you're going to find it. And that's what I'm showing you here today. So real quick, let me take all this vertical line stuff off. So on your own charts and in your own journal, show that in there and mark it all up. So can you see this diagonal business here? See that right there? In my mind, I see that as retail traders drawing a line from that low up through these lows up into here, and they see that as diagonal support. In my mind, I think to myself, well, we ran straight from the low at London low to where we went to the liquidity here. And if this is being shown visually where a trend line could exist there and it looks like textbook, then I look at, okay, they might utilize that in the opening range or in the first hour trading. So then I would look for some setup going forward that would yield a disruption to that potential. Well, let me just draw it so we can see what I'm talking about. I am not a trend line trader, but I teach the idea of phantom trend lines. So I see this and I'm like, okay, where's the midpoint? That's this liquidity right there. So I would like to see if this doesn't get disrupted before 9:30 opening bell. That to me is an area that liquidity right there is interesting. Why? Because retail sees this as support. The midpoint of that, and I teach this on my paid mentorship content that's already on my YouTube channel. Just go through 2016, 2017 ICT mentorship. They're all lectures there. They were all taught back then, and this stuff still works today. It worked before I taught it in the paid mentorship. It's just perfect. It's perfect logic. It goes after the less informed crowd. And diagonal support and resistance, again, Tori, I love you. I'm not trying to beat you up. It's not meant to upset you or anyone that believes what you do. I just personally look at that and say, I'm going to attack that at the right times. Okay, if it's there and everything is yielding a setup that would go against this logic, that's what I'll do. But it helps me frame pools of liquidity that are just real easy bread and butter type setups. All right, so let's zoom out real quick and go out to a daily chart. I'll get a feel for what it's doing here. So you can see we're inside this range there. And on the daily chart, I mentioned this. I don't know. I don't know what day I told you, but it's in tweets. I don't know where I actually said it, what date was. But these highs here are real smooth, and I'm looking at that as a higher time frame, macro time frame daily. This is where I think ultimately it's going to try to get to. Will it get there today? Will it get there without coming lower than it has here? I don't know. I'm not trying to predict that because we're inside this first month, first couple weeks of trading where I don't really go out there and try to push the button and do any of that stuff because it's like the Asian session or the accumulation phase of the yearly candle. I'm not trying to get in here and get positioned so fast. I'm not impatient, which is why I wait until the first Tuesday of every February. I'm not trying to do anything that's going to take on risk because I want to see what are they laying down as a trap? What are they drawing into? How are they behaving? Is price action smooth? Is it coming out the gate at the beginning of the year real aggressive and ranges are clean? There's no difficulty for prices to run to liquidity and it's leaving nice obvious inefficiencies and it's coming right back to it and it's respecting time. See how I just said a whole lot of stuff. If you're brand new to me, that means nothing to you, but someone that's been with me for a little bit of time and they know my vocabulary, my definitions, the logic of which I teach, price action follows, then you can fully understand why I'm sitting on my hands because I don't want to rush out there just because now we have a new year. It's a New Year's resolution. I'm going to make money in trading. Okay. Just because it's a new year and just because you want to start trading and the markets are available and they're trading doesn't mean that you should be plopping yourself down in front of these screens and start gambling. You have to know what you're doing, when you're going to do it, and why you're going to do it. And there has to be some structure behind it. So, anyway, that big green box is this here. So, I want to kind of like show you an answer to, I get this question so many times. Please, ICT, please, your chart looks different to mine. Mine doesn't have that volume imbalance. Mine doesn't have that gap. When do you use the set down here? Okay. See how I have this highlighted? The volume imbalance is not shown. When I toggle it, it appears. See that? So when I'm watching price action, I've said this before, I'm toggling on and off every time I refer to the daily chart because I want to see like that volume imbalance right there disappeared. Ah. But that to me, okay, is hidden information if you have this setting toggled on or toggled off. I don't care about the opinions of people saying, don't have it on, have it off all the time. I don't care about those individuals. Okay. You're going to have your own logic. Everybody out there trades with their own interpretations. Okay. Whether you make money or lose, I don't care. They believe in the moon phases. They believe in astrology. Oh, Sagittarius is doing this and Jupiter's in retrograde. And that means, pork bellies that don't trade on contracts anymore are going to come back and now we're going to be able to corner the market in bacon. None of that's real logic. But people with gout and tennis elbow think that the market's bullish too. So if you look at the chart and you toggle it on and off, it gives you visual representations where these gaps or inefficiencies exist. Otherwise, I don't care about having the setting on or off. That's the only interest I have. So I look at price action just sitting here. I'll listen to some music and I'll go through my charts and I'll toggle it on and off. And I'll do the same thing with ES and I do the same thing with the Dow. And where the inefficiencies appear by toggling on and off, now watch, look at this candle and go right back to this one here. We're only going to look at that. Okay. Just looking at that. Do you see any major discrepancies? Not so much. Go back through this high to that low. See any major discrepancies? Not so much. Now, this high down to that low right there. What's jumping off? that inefficiency down here, which is why I taught you and showed you in advance that there's the suspension block. It has a volume imbalance at the low, buy side imbalance, sell side efficiency, and then the high of it has a volume imbalance. But that volume imbalance, if you have your setting toggled wrong on your daily chart, you won't see it. Okay. So that's all I'm doing. There's no mystery to it. It's that simple. I'm just toggling it on and off, and I'm going back through price action in the range that we're inside of, which is that being defined by that low and that high. Everything has stayed inside of that range since then. So I'm looking back, where's the inefficiencies? In every smaller price range, I'm looking for inefficiencies, volume imbalance specifically. Okay. That's what I'm looking for. I'm looking for the close and the opens. Where are they at? Because they change a little bit. Okay. You see them, they change slightly different. That closing price is not going to be the same whether this is toggled on or off. It's going to be a discrepancy there. All right. So um, I'm already over the boundaries I told you I'd be at, but you know how I go. So here's a 1 minute chart on NASDAQ. And you can see since we hit that liquidity, that was Asian session buy side liquidity, what has it been doing? It's in a holding pattern. Okay. What is this low in that low? Here to there. That's a relative equal low. Now, if it wants to dive down in there and disrupt that, that liquidity is the one I'd be looking for. But caveat, that low has a wick, or in this case, a shadow, okay, or tail. This little bit of business here, you want to make sure that you grade. I'm not going to do it with mine, but you want to grade that lower quadrant, consequent encroachment, upper quadrant. And if it takes out that low, it could only just go down inside this wick to the lower quadrant or the consequent encroachment of it. So not every relative equal low or relative equal high is the same. If your anchor point that starts the determination whether it's a relative equal high or a relative equal low, that means the furthest one to the left. Okay. This is a swing low. This is a swing low. If you're referring to that as the beginning point of defining your relative equal low, if that low has a wick, you got to grade it. Because if you're wrong, chances are it's only going to go down into upper quadrant, consequent encroachment, or lower quadrant, and then reject on you and go the other direction. That's kind of like where you're going to fail because you're going to expect that to be taken out, and it won't. It'll just trade into that range, and then that'll be the end of it. I mean, it'll go the other direction. Same thing here. You have relative equal highs here. Closest one to market price here has got to be rather lower than the one you're anchoring to. Anchor point is point number one, the higher of the relative equal highs, and anchor point to the relative equal lows is the lower one. If that low or high has a wick, if it has a wick, you have to grade that. And if you're in a trade or if you're paper trading or if you're tape reading and you're looking for it to run to that and go higher, always, always, without fail, never, ever, ever not do this. You have to take some kind of a partial. I like to use anywhere between the lower quadrant and consequent encroachment. So split that in half, and usually that's usually I'm trying to take a partial there. That way, I don't have to have the high taken out. It doesn't need to do that. And it doesn't need to trade through consequent encroachment because if it fails, consequent encroachment is going to tell you the information that you're looking for if it's going to fail. Because if it stops short of consequent encroachment and it doesn't even touch it when it runs up, that's indicating what? Weakness. It can't even breach the consequent encroachment midpoint of that wick. So if it's going to go the other direction, that's usually indicative of what you're seeing when there's a wick in the relative equal high and relative equal low. And you see how I just explained that in a way that there's no way that I could have done it satisfactory, in my own opinion, doing that in a book. It doesn't communicate the same. At least for me, it doesn't. So I know a lot of you be like, see, that's why you shouldn't just do it. Just do everything in video. I do. It's why it's here. It's on my YouTube channel. That's why I said don't buy my books. But for the folks that do end up just buying the book, okay, you're going to look at these examples and be like, it doesn't feel the same. I don't feel like I understand it. It's because you have seen me teach dynamically over price action and seeing it deliver with examples, talking about it in X and talking about it in live streams. And when you were behind the paywall, you watched me talk about it all the time, every single day. It was panning out, panning out, panning out. So while books are wonderful and I love books, there's only so far a book can take you when it's very technical, like trading is and reading price action. So these are the types of examples that I hopefully bridge that gap between what I'm aiming for when I'm discussing it in print versus showing you to in the chart where it's likely to perform and what it's likely not to do and how it will behave. So the next bit of business in the morning, what I do is I go to regular trading hours and I highlight previous settlement regular trading hours. Okay, that's this price right there. So if you look up here, upper left-hand corner where I'm showing my mouse, that closing price, 25,933 half. Okay, I put a line there. We'll just use some manly color purple, and then we'll watch what I'm labeling. Okay, regular trading hours, opening range gap, and I'm going to just put high in here now, and I'm going to look at where we are and where we're trading at. It's 7 minutes after 9. Already, you're thinking I'm going to be doing the whole session right now. If you're thinking that, you're wrong. Not to hurt your feelings, okay? But I just went a little bit further on because you know how it is. All right, so middle in the right, so that way it's going to highlight over here, and then that's a little too much. So we'll just there it is. Okay. So now that is regular trading hours, opening range gap. It's not the high or low yet. I don't know that yet until I go into back into electronic trading hours. So we are significantly higher than that. Scrub down. Did I lose it? Oh man, eyes. 25,933. And let me make sure I have this showing on. Yeah, the width is 4. 25,933 half. 933 half. Yeah, we're significantly higher than market price. That's up here. So it is relative to the opening range. It's going to be the high because where we're at here, it's not likely to trade from here unless, obviously something crazy happens in the world. But that likelihood of closing that out between 9:30 opening and where we are at now, not likely at all. So regular trading hours, opening range gap high, and then you can copy that by tapping it, hold down control and drag it away. You can copy it like that. And then you can put it in close proximity where price is at and then wait for the 9:30 opening and then drop this on, but have it show below. And then once you have that, then you can drop your fib from the opening price at 9:30 up to 25,933 half, and then you can grade that opening range gap. That's the regular trading hours opening range gap. Okay, it's not new day gap. Or, I'm sorry, new day opening gap or new week opening gap. It's just the difference between previous day settlement and regular trading hours to the regular trading hours starting. So Friday's settlement, regular trading hours, to Monday's regular trading hours opening, which is 9:30 Eastern time. Okay. So it's a huge gap there. And right away, what do you think is likely? It's going to want to explore up into that, right? And what else do we have up there? This week's new week opening gap. You're probably looking at that thinking, "What is this?" I'll get to it in a second. And we have first percent of fair value gap from January 7th, the new week opening gap for this week, and we have regular trading hours opening range gap all the way up to essentially the low of this week's new week opening gap. So having these levels, and if you again, that's my little notebook. I have these levels just in numeric format. They're stacked in the order of highest to lowest, and there's little sign, little shorthand notes telling me what they are. Just the same thing I'm showing you here. So there's nothing that I'm willing to show you. Let's put it that way publicly. That's on my notepad. Beyond that, this is the only things that you need to have on your chart. Old data. I'm not even using the opening range from Friday. I'm not using the opening range from Thursday. Okay. These levels are just salient to me because they're impactful and they go back a full week. So last Monday's trading to now. So I'm looking at 5 trading days back, not counting today. Go back and you have a whole week of trading, and these are the most salient PD arrays that I'm interested in. My interest. It doesn't mean that if you have something else in your charts that that's somehow less important. No. You have to take these concepts that I've taught you and make them your own. What are you going to focus on? There's no there's no inherent wrong way of applying what you're looking for, especially when you're in these lower time frame charts, because there's all kinds of opportunities. But knowing when the market's going to draw to them and what you're framing it on, the highest probability is what I've shown here today, where you're looking at the time aspect first, relative equal highs, relative equal lows. What happens if you go back through price action and there's no smooth highs or smooth lows like we have over here in Asia? Like, say these didn't exist here, okay? Say this wasn't so smooth. Say it was just this high, and this was just a continuation lower and didn't create this obvious where your eye jumps right to it. Then this high here, that would be a single high liquidity where that would be overnight highs. That's where I would aim for. But because these are smooth, if it's going to go here, how far can it go? It's going to clear up and disrupt this smooth area over here and make it jagged. And I think everybody watching could see that that was made jagged. And it's being held in that holding pattern I told you. It's being held. Why? Number one, there's no news. Two, it's ahead of CPI tomorrow and PPI on Wednesday. So there's a lot of reservation on the part of speculators. So there's no interest in the market running, aggressively either way because it knows who's it or what is it. The market makers know there isn't going to be a lot of participation. So even if it does keep printing higher prices, because that's what it's doing, it's not buying pressure. It's just going to keep offering the price higher, higher, higher. It knows that market orders are going to come in and it's going to print and allow your chart to populate and show that price level. It's not likely to do that because the volume of big, deep pockets coming into the price behind it that they can later on utilize as counterparty. That's the real market making. Okay, don't listen to Einstein on the floor. Okay, he's doing nothing different than you and I. He's looking at price and guessing. That's what that is. Okay, so when he says that nobody's trying to do your liquidity sweep or your stop rate or whatever, that's exactly what's going on. That's exactly what's going on. So if you have, go watch Pax Trader or listen to him. He was down here. He's the biggest guy in the Nasdaq pit. And he was telling you stories that he was watching another house try to run him out. But then you hear Einstein say it doesn't happen. Come on, man. You got to consider who you're listening to, okay? So give me 1 second here. Got to let my son, he's coming in late. Anyway, um, having an expectation of the market not really wanting to run aggressively one way or the other because they won't entice the participation. Okay. It doesn't matter how many contracts are traded. If the algorithm or market makers want price to go to a specific level, they will continuously keep offering it in one direction. That's the reality of it. It's not buying and selling pressure. You're just going to see whoever is getting filled at those market prices as prices being continuously offered higher, 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 or in deference to when they want it lower, when it's going lower. Okay. So try not to concern yourself so much with volume because volume is not pushing price. It is not. It's just reflecting yesterday's news. Where did people get filled and how many got involved in that move? Has absolutely no bearing at all on what's really pushing price. Because what's pushing price is the intended outcome that those in power that control price, that's what they want. That's what they want. And by you seeing the reflections of price action over the lens of volume, how many people bought or sold at a particular price, I don't care. That's like saying, how many people bought the car that I like yesterday? How many bought how many people bought the new Zora Corvette? I'm going to base my purchase on how many people bought the Zora Corvette. That that's 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 important to me. That's not important to me as a trader. I want to know what I'm looking to see trade to. Notice the difference there? Volume is looking at what already happened. I'm teaching you where the liquidity is it's going to draw to. That's not reacting to anything. That's anticipation. I'm teaching you to look at inefficiencies that are in price action that are not hiding from you. And I'm telling you where they're going to form before your low volume nodes even come into existence. No advantage, like I said. So the point is knowing what you're looking for in terms of time, look back. How far are you going to consider your range? Why are you considering that range? Because all of the activity, the sentiment that was inside of London, Asia, and the same thing is done for the New York session. So in New York session trading, you would use the 9:30 opening to 4 o'clock close Eastern time. So if you're going to be an Asian trader, or if you're going to be a London trader, that's your information you would use overnight or during those hours. Look for the smooth highs and smooth lows, or look for singular highs and singular lows that were very dynamic, like we explained here. Okay. So anyway, how you feeling today, Caleb?
I'm doing quite well. A little tired, but I'm here.
And you're late.
I am.
So he will get the paddle board and put some towels on his face and pour some bottles of water over top of him and see if he can hold his breath.
Mm-hmm.
Training.
Mm-hmm.
All right, so that's the real train. You all want to come here and train with me, but that's what we got to go through. We go through, hanging you by your thumbs and your big toes, and learn how to trade upside down. Because everything in retail, we want to be diametrically opposed, and that's how I train my sons. So, anyway, the point is this: we've seen the market run to the liquidity that was outlined at the beginning of the stream. I didn't need to talk about because it was right there on your screen. The prices ran up. Okay, we talked about how um, relative equal highs and relative equal lows are a factor in price delivery. It matters not the volume. I don't care how many people bought. I've never considered how many people traded at a particular price level. I don't care. Um, I don't care how many orders were filled above the Asian session buy side liquidity level that I've highlighted here. I don't care. It doesn't matter if one contract printed at that price level or 5,000. I don't care. I don't care about that because I'm looking at what price is going to do next, not what did it do and how many people participated in it. I don't care about that. I don't care. Look at your book map, okay? Look at your level 2 data and look for these big orders. I can show you if I find a live streamer that's doing this, okay? Not that I'm not trying to beat anyone up, okay? But send me a link in X where some guy or gal is using that type of information and they're saying price is going to go to that level because look at that number right there. Okay. And I will diametrically oppose execute against everything that they're doing. And I'll prove the point that that is not advantage. And I will use what I'm teaching here. Okay. I'm telling you, in 2026, I'm going to wreck everything you think you know. Everything you think you know. Okay. I'm not coming for any one person, I'm coming for everyone. I'm going to roll over everyone. Okay. Everything that you think you've learned in price is flawed. It's a lie. It's a myth. Okay. Volume is not the secret. That's yesterday's headline news. This is how many people traded. This is the volume of trades. It's the same thing as watching the news at 6 o'clock and they say, okay, NASDAQ was up, blah, blah, blah. And this is how many shares traded that day. Wonderful. How are you going to make money off of that? You can't go back in time and get in that same price. You can't do it. And just because you have a volume, shelf high and low, and a point of control, my first presented fair value gap is the real control. Me teaching you, showing you where the session high and kill zone high and low, buy side and sell side liquidity. That is the real high and lows that it's going to draw to. That's the benefit of knowing what I'm teaching. It's not borrowing logic from anything else. It's just focusing on time, focusing on time first, so that way you can frame what it is you're hunting. I live in an area where there's a lot of deer all the time. They're always migrating around, looking look out the window any time of the day, and you're going to find one. Well, there's areas up here where if you're driving through and there's a lot of farmland and whatnot, and you'll see these little tripods out there towards the edge of the forest, and they're feeders. And what these things do, they drop down pellets and whatnot to feed these deer to keep them coming back to eat there. So that way the hunter can eventually come back with his stand, set up his little hide, and then wait for this deer so he can ambush them. Okay, so what has he done? He's mapped out, he's framed out his kill zone. He's not going to go treading through the forest and the woods looking for a deer. He knows that this is what it is. Well, when I look at these pools of liquidity, session highs and session lows, inefficiencies inside of that, their setups, their draws too. But I'm looking for relative equal highs, relative equal lows in deference to the session entirely and the kill zone. It's not just the kill zone. It's not that. So if you go back through the whole entirety of session start at Asia, let me put just for a second here, let me put the lines on because Caleb just got here and he's missed it. Okay, so there's Asia session start at 7 p.m. last night. From this point all the way down to this low during London, right before 4 a.m., there are highs and lows in here, okay, that can be used for fair value gaps. That's not my first interest. I'm looking at where in that range from that low all the way up to the highest high of Asia, I'm looking for where is it smooth? And it's not as easy doing it this way versus when you crunch up your chart. Look how much more clear you can see how that's very, very smooth versus anything else in that range. You see what I just did there? And when you watch these folks and they're streaming and they have their charts like that, like you're literally you have your nose to a tree and you're trying to see the forest. You can't see anything. You have to zoom out. Like you have to get a broader perspective. And by zooming out, it gives you a perspective that helps you quickly, without any doubt, where is the smooth edges that will be made jagged. And you do it by compression on all your ranges. See that? So you can see clearly that there's a smooth level. There really isn't any, well, that kind of is right there to me. I like that one. But this one is obvious. And it's about, it's in the lower half of the range defined by 7 p.m. last night, start of Asia session, to 5 a.m. when they close. all this business dropping down, relative equal highs, start at 7 o'clock in the morning. It's going to run and upset that distribution of shorts. They're protecting that with their buy stops. So that's buy side liquidity. And because there's no news, we're in a holding pattern. Look at prices done. Say you want to do, I was aiming for that, but it's jumping around. There you go. Say that is what you're looking for if you're a trend line guy or gal. Okay. Midpoint is still that low and it drew down into that. Same thing here. Diagonal support, midpoint is here. So that liquidity drew down to here. We're back down into old lows, inefficiency, and first presented fair value gap of pre-market session, 7 o'clock to 9 o'clock in the morning. That window is this, Caleb. That right there. So this is all anyone really needs if they're brand new and they're starting. If they just look at the price action just inside that window and look at overnight highs, overnight lows, overnight relative equal highs, overnight relative equal lows. They will be inside of the highest high and lowest low of the session sometimes, just like that Asian session buy side liquidity pool was. It's inside of the entire range that was overnight. So it's not just simply what's the high of Asia. You use that information. It can eventually trade to those levels, but inside of the range overnight, you're looking for where is it smooth? And the probability of it running to them vaults, it increases exponentially if it's part of or around a quadrant level of the entirety of the range. Did that go over your head?
A little bit.
All right, so let's just for I gotta get a better trend line here. Same thing if you use that logic here, midpoint. This is exactly what I teach in my lectures on. I don't recall if Kit was here, he'd tell me the friggin' minute number, the video, the what month, what lesson it was. I have students that are really, really, articulate with keeping records of where I said what I said. But just look for phantom trend lines and the way I use them and teach them and how to attack that specific pool of reference and liquidity. Right. Let's go back to 7 start time. And this is a candlestick it started on, right here. So this is your high, and that is your session low. Okay. I'm going to just for a second remove everything, and we're going to grade that high down to London's low. Okay. So here is midpoint, upper quadrant, lower quadrant. So inside of the lower half, we're seeing that relative equal highs. Okay. You would look at it like this. Go back through that whole range of price action, and you should be able to see how that's very, very smooth. Okay. Until this little business right there, that was smooth too. Either one of them would have been good. But because this one was disrupted, that was left. And then you see this price action here. There it is. So let's go back because we just opened up. Remember, I was saying earlier, we have new week opening gap higher. Let me do this. Boom, boom. Everything's back. Now we put this regular trading hours low on the opening candlestick. Open price right there. Open price is 746 quarter. Okay. 746 quarter, and I got it on 3/4. So let's change that. There it is. All right. And regular trading hours, you'll see that that's a discount gap. It's low. And the previous session or trading hours close is up here. So there's the gap. Okay. All that right there is the gap. We go back to electronic trading hours. Disrupted the liquidity I told you it would reach for. Don't take my word for it. Go back and listen to the stream, everything we were looking at. Traded up to and through first presented fair value gap from January 7th. We're inside of the Asian session displacement from January 7th, and I didn't get a chance to show you what that is. Let's just watch this for a couple seconds, okay? And 933 half. 933 half. We'll fix that when it dropped on here. And 746 quarter. All right. So consequent encroachment, opening range gap has been now tagged. So there's your 70% likelihood before 10 a.m. It's done that. Upper quadrant is here at 25,887 even. And I'm showing you eighths. Okay. So don't be confused by that. Just look at the little number here. Like that's an eighth. That's upper quadrant. This is consequent encroachment. So there's this big vacuum, okay, of no price action during regular trading hours between where we settled at 933 and a half up here and where we opened here on that candle. So if think about you have a carbonated soda, okay? All of a sudden you flip the tap on it, and what's going to happen? You're going to hear there's a release. Okay, well that is what's happening right now in the marketplace where there's this big compression inside that range, but it's void of any kind of price action delivered to it at all during regular trading hours. Even though there's a big important thing here. Even though we traded through this area here overnight, and this is Asia session high rate there. Okay, so that's Asian session high. The highest high that that session had is this level right there. So you would have that highlighted. And let's make it black because I want to see it stand out a little bit. Okay. So the only thing they did was came down and disrupt that trend line, like I told you. That was your Judas. No need for it to go down into this business down here. Subtle little retracement and then expansion into the outside. Real aggressive run into old PD arrays. Upper quadrant is here. Asian session high here. And then we have new week opening gap here, all during the same time that we showed on the daily chart that those relative equal highs on the daily chart, they are too smooth on the daily. So it creates this perfect storm where price will want to rush into that space where there's no real trading during regular trading hours. Again, let's go to regular trading hours and take everything off the chart for a second. We started trading down here, that price right there. And that gap goes all the way up to here. So you see how it's rushing back in. Okay, it's rushing back into this unpopulated area of price action. Even though overnight on electronic trading hours, it has already traded in this range. It hasn't traded up here yet, even in electronic trading hours, but it has traded where we're at here. So we're basically overlapping what electronic trading hours has already done. All right, let's go back into electronic trading hours. This candlestick right there, while you were driving here, Caleb, I was discussing how this is pre-market session trading time, 7 o'clock to 9 o'clock in the morning. This is the first presented fair value gap right there. Right here, because it's taking out a high and its displacement above that high. And it's not this little tiny little separation here between this candlestick high and that candlestick's low. That's not the fair value gap. It's breaking through in the direction we already determined that it was a draw. We've laid out several things this morning while you were driving over here. The fact that we're opening low at 9:30, it's going to be a discount opening range gap. The new week opening gaps above us. The relative equal highs are above us on the daily chart. There's several PD arrays that are highlighted here. And there's so much of a vacuum price to want to go back into this area. Then it keys off of the level Dad talked about as the first presented fair value gap over here during the pre-market session hours of 7 o'clock and 9 o'clock in the morning. And yet, watch and see. You will still see people say that none of this was explained beforehand. It's always after the fact in hindsight. When I'm literally doing it live stream, I don't know how many people are watching. What's the numbers on the live stream now? Like 20 people watching?
Probably like 12.
Einstein on a stock exchange floor would never tell you that this is what that was. Yet, these people make lots of money. They make lots of money. They're pillars in the community. You can see them. You recognize them by their faces. You may not even know them by their name. Like I can't even tell you what the guy's name is, but I know if I see a picture of him, you know who I'm talking about. Einstein. He looks like Einstein. He's a floor trader. Um, I'm convinced that they just have to play their role. They just got to not upset the apple cart. They know what's going on, and keeping it hush hush and just playing along with it. Like nobody's really trying to run your stop orders. Well, here's Pax. He's off the floor. He was in a live stream with Kit, and I was in there, and he joined in, and he literally said he was having another house, another clearing firm, try to run against his orders. That's a floor trader telling you that. The biggest floor trader in the Nasdaq pit. Who do you going to believe? You're going to believe people that say there ain't no stop hunts, nobody's going for your stops, and here's the guy that's the largest one in the pit, and they're trying to muscle his orders, and you don't think they're trying to muscle the existing orders above relative equal highs, relative equal lows, or session highs and session lows? Come on, man, seriously. I mean, I get it. Everybody's a team mentality, but you got to be your own team. Mm. All right, so upper quadrants now been hit. So we have the other remaining portion or last quarter of the gap between regular trading hours session close last week and this upper quadrant level. That does not need to be delivered at all. This right here is enough to prove the things I've outlined this morning, where it was going to go. Where's the draw? Where's the direction? Up. Filling in this area. Everything going higher. Everything reaching towards that level I talked about on the daily chart, those relative equal highs. They were on the daily chart. They were real smooth. You probably didn't see that, Caleb. So let's take everything off for a moment. Go out to the daily chart. This is your chance right now. If you like what you're seeing, like if you're learning anything from this, there's a little free button. It's a thumbs up on it. I promise you, it doesn't make me any more money, but that's like my report card that I use to determine whether or not I'm going to be interested in coming back out here and doing any more of this. So if it's a good number, then obviously that, I'm entertaining you, right? You're learning something. So 26,133 and a half, that was the level I mentioned, a week or so ago. I don't know where. I said, make sure you have that on there because on the daily chart, this is a potential draw. Does it mean it goes right there today? Does it go there this week? I don't know. I wouldn't be surprised if they use the CPI and PPI number to run it through that. That's what I would reasonably expect, but it doesn't have to happen that way. I'm just saying that I like the idea of framing the majority of any setups, they should be in that direction. Okay. Even though we're in this big consolidation, this is a likely draw. And in and of itself, by itself today, it's already proved effective in terms of determining direction. So you're sticking to a bias that's derived by the higher time frame daily chart. We literally zeroed in with precision, outlining how retail would be targeted using their supposed diagonal support ideas. Okay. Not one volume profile thing was even mentioned today. And I gave you so far the low of the morning session, the direction it was going to go in. And you're going to argue this. You're going to say it didn't happen. You're going to come at me and you're going to say something in X that has absolutely no truth to it, but we're all watching it happen. If he failed, he wouldn't show it to you. If he would have lost on the trade, he wouldn't have showed it to you. Well, I'm out here in front of everybody live, explaining why it's going to do what it's going to do, where it's going to do it, and how it's going to do it, and what time it's going to do it. To me, that's somebody worth listening to, especially if it's for free. Come on now, no upsell. Wow, there's 6,800 people watching me. I'm getting nervous. I'm getting nervous, Caleb. So it's basically ran about 150 handles or so, which is a nice price run. I mean, that's a really decent run. But on the grand scheme of things, it's still minute and small. But if you're on the wrong side of this and you were expecting to go lower, it feels like a mountain of a move because it's steamrolled over top of you. You probably didn't understand where it was going to come from. Everybody watching the stream knew where it was going to come from. And the little boy can say, came for his volume profile. Come on, let's see here. Um, if you consider the factors that we outlined so far today, like you say you were long off the first potential fair value gap that I outlined at 7 o'clock start of pre-session time. Say you close your trades right here, you're done. You're completely out of the market. You're done. From this point here to where we're at right now, which is upper quadrant of the opening range gap. That's this level right here. Okay. Full closure, the gap is up here. You have already secured the lion's portion of the move and the entirety of the present daily candle from low to high. But yet you're not supposed to know how to time the market. They're going to tell you you can't time the market because nobody can do it with any measure of consistency. I love that. Like I love that because that presents what? The opportunity to exact revenge on people that oppose what I do. I love it because it gives me the fuel. It gives me the moxie, if you will, to continue doing what I'm doing because I love proving people wrong. Because what I'm trying to do, I'm gifting this to you. I'm not selling it to you. There's no price tag on it, your time. But clearly, find somebody else out there that live streamed today and explained exactly how the market was going to do what you're seeing it doing right here today to the very levels that it delivered from. Go back and watch the stream. If you came in here late, this is it, baby. This is it. You're not finding that in volume profile. You're not finding that in Elliott Wave. You're not finding it in any other borrowed logic. And it's not rebranded anything. It's just simply you learning how these markets are really booking because they're algorithmic. It has absolutely nothing to do with volume. Volume is just a reflection of how many people did something at a particular price. They didn't move price. Volume didn't move it at all. It didn't move it. Period. And you can argue and say whatever you want to say, but they're not giving you any advantage. It's just you simply saying, okay, this is how many people bought or sold at that level. And I'm going to believe if it does trade back to that level, I will make a decision based on that. That's you reacting. You're reacting to that. I'm anticipating. I'm anticipating. I'm teaching you as a student to anticipate, not react. If you're honestly always simply looking at the chart with the intent of reacting to something, what are you doing? You're trading hypersensitive. You're always looking for something. And since you're in a reactionary mindset, you're going to be more in a position of like God bless you. You're also in a position where you're going to probably have your mind or your convictions about what you think is going to happen in the price action. It's going to be easy for you to have your mind changed. So you're going to be changing your bias back and forth, up and down, up and down. So being a reactionary, okay, is foolish. You need to anticipate. You must submit to the idea that you are predicting price. Every one of us are doing that. And for the people that try to say that they're not, we're not trying to be right. What they're doing is they're making allowances for their high number of losing trades, their low accuracy, their low delivery of successful trades. That's what they're doing. They're coping with that. That's why they talk the way they do. That's the reason why they talk the way they say. And they come at me and come at you as my students because we don't talk in a defeated mindset. We don't talk about how we're going to react to something. We don't go out in the car when it's done snowed and say, I'm going to see how fast I can go. And then I'm going to react to the sliding that's caused by my own actions versus it's snowing. I have to go somewhere. So I got to get somewhere. But I'm going to drive with sense. I'm not going to go out there and drive faster than I should. And I'm not going to apply the brake abruptly as I would if it was dry concrete. I'm going to slowly work in my stop by taking my foot off the acceleration pedal and then slowly feather the brake. And then you won't ever slide. So what are we doing? We're anticipating. We're anticipating that. Not I'll react to it if it happens. And what happens when people start sliding? The natural reaction is they're going to react and put the brake on, and it's going to cause the slide to increase. See the difference there? Mindset. And having an anticipatory mindset, we see that there is a likelihood that we could start sliding. We could lose control and traction. So we don't do anything. We wait. And then when it's time for us to do something, it's already based on something that we already expected. So we're predicting, we're not reacting. So now imagine if you didn't take off your trade and you're sitting here like this. Would you feel confident it's going to continue and close over above the Asian session high or have a deeper retracement back down into the 780s? Knowing what you're looking for, also when it delivers a big rush of a price run like this did here, that run, because it was parabolic, it was real quick out the gate, and it's already done 3/4 of the move. That's this right here. 3/4 of the opening range gap between last Friday's closing